financial advice. I'm recording my thoughts about SoFi stock. In the past 1 month, SoFi stock rallied by about 100% and it is currently trading at about $9.5 with a market cap close to $9 billion. One of the main reasons for this rally is the end of student loan moratorium on August of 29. Since SoFi deals with the refinancing of student loans, this is supposed to help SoFi's top line and bottom line. Since the stock rallied to $9.5, the question in everyone's mind is that whether to buy this stock at $9.5 or not. For that, we have to look at two different sides. On one side, we have to look at what can go right and what is the upside. On the other side, we have to look at what can go wrong and what is the downside. If we are aware of these two sides, we can make an informed decision. Before I go into the details, I want to clarify that I do own over 500 shares of SoFi at a cost basis of about $6. Let's first look at what can go right and what is the upside. Firstly, we have to understand that the student loan moratorium is going to help SoFi. In the past quarter, they raised their guidance from $2 billion to $2.02 billion in revenue. If the student loans are going to come back, SoFi can give a better guidance in the coming quarters, and that's going to help the stock. On the upside, this company already has $2 billion of revenue, right? So for a bank, price to sales of 10 is very expensive, but due to the hype, in my opinion, it can get to price to sales of 10 and get to $20 billion valuation, in which case the stock price would be about $20. So that represents another 100% upside from the current $9.5 price. The second aspect of what can go right is related to SoFi's profitability. In the quarter 1 of 2023, their loss was about $34 million based off of a revenue of $472 million. That's a net profit margin of -7%. SoFi has 3 more quarters to adjust their operating expenses and increase their revenue. In my opinion, -7% net profit margin is coming very close to profitability. SoFi is continuing to execute well and reducing its losses. So in my opinion, single-digit profit margins by end of this year are not very unlikely. If SoFi achieves GAAP profitability, that gives a lot of investors a reason to invest in this stock, and therefore the upside could be again $20, which comes down to price to sales of 10. In conclusion, on the upside, I'm expecting a price tag of $20 per share, and that could be caused by GAAP profitability and increase in revenue guidance in the coming few quarters. Now let's look at the other side of what can go wrong and what is the downside. The first aspect of the downside is SoFi's book value. As you can see on the screen, their assets are about $22 billion and the liabilities are about $17 billion. So the book value is about $5.2 billion, which equates to about $6 price tag. Retail investors may not focus on book value, but for a bank, institutional investors focus on the book value. If institutional investors realize that the stock has gone up so far when compared to its book value, they can start selling, and that's going to cause a downside to the stock. And like I said, based on the book value, the fair price is about $6, so that represents more than 40% downside from the current price of $9.5. The second aspect of the downside is the statement made by SoFi in their 10Q in the most recent quarter. This is what they said. If we are not able to achieve GAAP net income profitability in 2023 as currently expected, we may raise additional capital in the form of equity or debt, which may not be at favorable terms when compared to previous financing transactions. The meaning of this is if somehow they cannot achieve profitability by the end of this year, which can happen, they are going in the right direction, but it can happen in a case where they may still not be GAAP net profitable. So in that case, they have to raise additional capital. There are two ways predominantly. One way is to get a debt. If they get a debt, that's going to be at a much higher interest rate than their previous transactions. So that's detrimental for the shareholders and the stock price. On the other hand, if they decide to raise this additional capital by issuing shares, then even to raise $2 billion, they have to dilute the shareholders by about 25%. That's significant dilution, and that's going to hurt the shareholders. And the third aspect of this downside is the valuation based on a PE ratio. Banks typically get a 10 PE ratio, but SoFi is still a bank, but it is a growing company. So even if you assume a multiple of 20 or a PE of 20, based off of current $9.5 billion of valuation, they have to make close to $500 million of net income. And they are nowhere near that. It may be 2024 or 2025 when they can achieve $500 million of GAAP net income. So the stock is way ahead of itself with respect to earnings. Based on this, the downside again is going back to its book value of close to $6, which indicate another 40% downside from the current price if you buy now. In conclusion, we're looking at a downside of negative 40% in the coming quarters, and this is based off of price to book value, PE ratio, and the chance of them raising additional capital by issuing shares or taking a debt. In conclusion, I'm looking at a gain of 100% based on the expectation of their increased revenue guidance, GAAP profitability, and also the hype surrounding this stock by retail investors. And on the other hand, I'm looking at a 40% downside based off of their price to book value, fundamentals with respect to the PE ratio, and also the chance of them raising additional capital if they don't achieve the GAAP profitability. There definitely is an asymmetric risk reward, but for me, since I'm already a shareholder of SoFi, I'm not going to buy this stock at $9.5. And if you want to buy at $9.5, you have to take a decision based on the upside and the downside that I just discussed. Let me know your thoughts in the comments. Thank you so much for watching.